Hello, everyone. Welcome to the stock-specific class here for Thursday, January the 12th. If you have any questions during the week or any questions that I don't get to here in the live class, make sure you, or any questions you have if you're viewing the recording, make sure you send those to jerry@traderspro.com. Now, before I get started, last week there was a clicking sound in the audio on the recording. I can't hear the whenever there's a click. Sometimes there's been clicking sounds that come in, and I can't hear them on my end. So if you do hear that, or if it sounds like there's an audio problem, let me know in the question box, and I can usually dial back in, and most of the time that takes care of the problem. If I can't figure out what the problem is, and I have to just kind of keep going, or sometimes it could just be one person, and it could, usually in that case it's on their end, they might need to dial back in or something like that. But let me know if you hear it, so that I can try to deal with it. I guess I went through the whole class, and it was pretty much unwatchable for the recording. So okay, so there is someone that is getting a clicking. Anybody else hearing a clicking? You know, I didn't have it in the market update class. Any of my other classes, it might be just this. It might be GoToWebinar's this class problem. I'll try to dial back in and see if that helps. So let me just do that here real quick. All right, is anyone still hearing a clicking noise on the audio? If you are, it's probably on GoToWebinar's end, and what I'll probably have to do is set up a brand new class. Like I said, it's not in the market update class. We haven't had any problems, I don't think, in the market update class. Is there still a clicking noise? If someone could let me know, I'd appreciate it. Okay, so it sounds like it might have gone away. All right, I'm going to go forward then, and but if you're still hearing it on your end, let me know. We'll try to see if we can figure out what the problem is. Yeah, sometimes technology is great, and sometimes it's a pain. So, all right, sounds like everything's good to go. All right. Well, actually, not much has really happened since since Tuesday's class. I thought it would be. I thought we'd get a little bit more clarity, but I'm going to show you where we're at, and we're at I will tell you we're at a very critical area. We're at a spot here where either we're going to get a pretty big sell-off any day, and then probably have to be starting tomorrow. You can always have some of these pause days or what have you, but we're either going to drop sharply here very soon, or we're going to be breaking out of an area, and we have to start to turn more bullish at this point if we break out right here. But we're at a critical area. I'll show you that here in a second. And I know I've gone off on some pretty big rants, you know, with my reasoning for expecting a bigger drop. But if we do break out, again, maybe we do end up still getting that drop. I still think we're going to get it. But an important lesson to learn through all this, if we do break out, is as a trend trader, you can't fight what the market is doing. You can't know what the market is going to do, but because of that, you've got to trust these key areas that you're looking at. And if the market turns more bullish, you gotta ignore your own personal feelings. You gotta ignore your your theories and your you know all the news you're listening to and everything, all that other crap. You gotta just you gotta trade what the price is actually doing, what the market is actually doing, and it's hard to do. It seems like it's simple. A lot of people say, "Oh, I'm a trend trader," and then they spend a lot of time fighting the trend. And now I know part of the reason why it becomes a problem for some people, and this is a good time to kind of check with yourself to see if you run into this problem. There's a lot of people out there, tons of people out there that equate getting the market direction right with being smart. If you can predict what the market's going to do and it does it, then you're smart. You're very intelligent, and so what happens is that if the market starts doing something different than what you were talking about or what you were predicting, then that's not going to make you look smart. And so you start to dig in and come up with every reason you can think of to try to convince people that you're still right. And you can do it. I mean, you can. I've seen people that start grasping. Well, back in the 1918s, it did this, and this person did this, and this is what happened, and so this could be a repeat of 1918 or something. They start grabbing for stuff they've never used in their analysis before, all to try to still be right. If you got a strong ego, you're going to fail at trading because the market will humble you many, many times. And if you want to make money, then you've got to be able to check that ego at the door and follow the trend. Whatever the trend is doing, make sure you go that direction. And like I said, it's hard to do, especially the longer you do it, because you do see things that happen repeatedly over and over again, and you expect them to do the same thing every time. And if they don't, then it's hard to kind of pivot and move in that next direction. I really learned to do this. My expertise is a little bit more in option trading. I've kind of made that my main form of trading over the years, and that was the hardest thing I had to learn, was to I've got to be able to pivot. I've got to be able to change direction when the market changes direction. And if you can't do it, I would get killed early on in option trading because I couldn't get myself to turn bullish when I needed to turn bullish, or turn bearish when I needed to turn bearish, and when the market was telling me I needed to do that. Now, this is another reason why the software is so good, though, too, is because it helps kind of point out. It takes a lot of the noise out of the decision making. If you're someone that watches CNBC all day long, well, first of all, you got to cut that out as much as possible. There's really only a couple of times during the day that I'll even watch the channel, and I've gotten to a point now where there's only certain people that I'll even listen to for their opinions or their insight, just because I think there's a lot of idiots on there. And you got to realize too that they're a TV station. Their objective is to sell advertising. And so a lot of these people that show up on there are paying CNBC to come on there, and they're paying CNBC to come on there to pitch their portfolio or their services. And so their objective is not to necessarily help you out; it's to help themselves out any way they can. And so it can be a little bit dangerous if you're going that route. But the software here cuts through all that crap, and it can tell you not only where the market is trending, but especially this first phase that we go through on these direction alerts, tell you whether the market is getting extremely overbought or oversold. Now, as with Tuesday, we're not The first couple indicators were not yet in any sort of extreme range. I still want to point out right here, you can see here's that, we're going to look at each of these individually, but there's that sentiment indicator. Look how extreme that is. It has gotten even more extreme as far as there's just no fear in the market. Now you say, well, isn't that a bullish thing that there's no fear? No, this is a contrarian type of indicator where it's true that when it's trending, you want to follow that trending move because as the market is becoming more confident, more and less fearful, that is a characteristic within an uptrend that you see. But when it gets extreme, when it gets too far, where nobody's afraid, the opposite tends to happen. That's usually the area where you start to see these big sell-offs. I'm going to show you when we look at the VIX indicator. And again, this is for those of you that are new. If you've never used the VIX indicator before, how it can be kind of effective in analyzing some stuff here. But I've been concerned about this for a while. It's so detached from the momentums right here in breadth that at some point that's going to have to balance out. Now maybe it means that it's waiting until momentum and breadth kind of catch up to it. But that's something that or that we're going to see sentiment crash and come back in line with the other indicators here. So momentum, you can see, is still trending. It's right in the middle. It'll probably continue to move this direction with the market. Well, the market's been all over the place today, up and down. But if it does continue to move up, you'll see that move to the right side. So this isn't showing any sort of extreme range. This is the rubber band. These indicators are telling us the rubber band. Are we stretched too far to one side? Have we gone up a little bit too far too fast, or have we gone down a little bit too far too fast? Now, this is telling me that if we do break out in this critical area here, that the market has some room to run. It could rally for quite a while before getting stretched, before getting that rubber band stretched to where it becomes overbought. It also tells me, though, if it holds right here and starts selling off, it can also move pretty far down before that rubber band gets stretched to the oversold side. So again, a lot is going to depend on what happens over the next couple days. Breadth is getting high and it's nearing that extreme range, but it's still it's reflecting what the market has done over the last several days. It's been more bullish over the last several days as we've rallied up. It's not stretched, so it could continue to move up. But there again, if we do sell off in this critical area, it has a lot of room to move to the other side as well. And then of course sentiment showing that very, very extreme complacency. And now this has been at the far right side right here, and this indicator can do that sometimes. So if you see it at the far right side, don't immediately start shorting the market just because the sentiment is extreme. It is in a bearish reversal area, risk area, but it's like I said, it's been that way for about the last 2 months. So or maybe even longer than that. So it's not an immediate indicator that you'd have to react to. Buy-sell ratios, buys have now outpaced the sells. We're approaching a little bit of a stretched area, but we're not there yet, and it can definitely get even more stretched in some of these conditions. So I don't see anything there that would cause me concern. In fact, it is pointing out, though, that the buys are outpacing the sells now. That is a bullish internal indicator there that we're starting to see that buying increase. And this sentiment indicator is right in the middle. Again, it could go either way, not showing any sort of a stretched condition there. All right, let's take a look at the charts. Now you can see how we've been kind of all over the place. We opened up, and then we came all the way down here, and then we managed to kind of fight back, and we're kind of flirting with the highs of the day, at least as of right now on the candle here. Now, this type of a candle, formation. Obviously, you can see the momentum there that the buyers were able to push price back up after it faded. Now, this is where not only do you need to understand the candle itself, but you need to understand the context of the candle. If you see this type of price action where it fades down and then comes all the way back up, buyers push it all the way back up. If that's down here at a bottom, that's showing up down here after a drop, that's a very, very bullish type of price action. We call that a hammer. When it shows up at the top, we've already had this run up right here. When it shows up at the top, it's a sign of buying exhaustion. It's showing you that it's showing you that sellers are starting to show up. Okay, so sellers showed up at the open today. We've had a big run up right here, so it opened higher. So that's usually a strong opening when it gaps up and opens higher. But then sellers were able to push price down. Now buyers came back in and they're fighting it. They're pushing the price back up. But what you're starting to see is you're starting to see sellers getting active. Is what you're seeing right there. They're becoming more active after this run up. Now, this isn't the strongest. Buying exhaustion is not the strongest reversal indicator. Okay, so if I saw that, I'm not necessarily going to go just short a stock or buy a put option just off of that behavior alone. I'd want some confirmation of that. Now, what would be confirmation? Today's low is going to be critically important. If in the next day or two we close below that low, actually you'd be looking at tomorrow. If tomorrow we close below that low and we're down lower than where we opened, so let's say we open down a little bit and then we trade all the way down and we close at the lows of the day and we close below that low from today. If this is what happens tomorrow, that would be a very strong bearish reversal behavior. Okay? And we're probably going lower at that point, especially in the context of what I'm going to show you here in just a second. Now, I've been very bearish on the market recently, mostly because of just the trend behavior. You had a impulsive down that broke this little trend line right through here. That's a bearish indicator, and then this is a correction of that. So usually it'll pause right here, and then usually you're going to continue to move lower. Now, we didn't do that. We broke above it. And so, that's obviously not following that behavior. But if it were to reverse, if this was an early sign of sellers showing up and it were to close, and this is a sign of buying exhaustion, and we were to close tomorrow below that low, then that's probably going to kick off a bigger drop at that point. Now, why is this such a critical spot right where it's at right now? Why is it so critical? And why am I saying within a day or two, probably tomorrow, we're going to know what direction we're going to move in? Well, this gets back to, let's go to a 2-year chart here so we can see it. We're right smack back at this downtrend line. Actually, why does it not look that way on mine? I don't know if it's let me go to my other, sometimes it depends on what the scale is on the chart. Here's my other chart here, my other charting service here. And I want to bring that in because this is what I've been looking at, right? So we since the decline last year, sorry, I'm a little congested today. I don't know about you, but I feel like as soon as the weather turns cold, I'm congested from November to March, even though I'm not necessarily sick. All right, so we started the decline last January, and look at every time we come up to this spot, this trend line. Now, you needed the first trend line to establish. So this established the trend line. You need 2 points to establish the trend line. extended this all the way out. Every time we've gotten right to that almost exact spot, we've sold off. Now, right here, we actually traded above it. This is the last. This is the CPI report last month that kicked off this selling right here. We actually opened above that trend line, traded above that trend line, but we closed back below it, and then we sold off. You can see right here, we're almost to the penny today, right at that trend line. Now this is not going to show up on TradersPro because TradersPro's not. It has algorithms that it's using for. But another thing that a lot of professional traders look at, this little red line right here is the 200-day moving average. It's right at that 200-day moving average as well. Now I'm going to flip over to the VIX indicator because the VIX indicator lines up with this as well. Here's the VIX, and you can see that we're back below 20 again. And every time we've hit 20, and we have gotten below 20, so it's not like we're looking exactly at 20, but back here in April, we got below 20, the market sold off, and the VIX spiked up. The market went down. So the VIX is going to be inverse of the market. If the VIX goes up, it usually means the market's going down. If the VIX goes down, it usually means the market's going up. Back here in August, VIX got down below 20. And now it was down below 20 for a few days, and then it sold off. Back here in December 1st, got below 20 here, and then we spiked up. Now, we did on each of these other spikes, we got above 30, which is indicating fear. The market got to fear. On this little spike right here, we didn't even get to fear yet. Now, there could be bullish and bearish arguments here, okay? Because the conditions are a little bit different in each of these areas here that we do have to pay attention to. But it's important, again, that we're down below 20 here. This means that at any moment we should see a sell-off, or we could see a sell-off, and that lines up, like I said, with the fact that we're at this trend line. Now, I am going to point out something that's a little bit different, though, this time around. One is, on each of these other sell-off periods right here, the market went to a lower low. So here was the previous low. On that sell-off, it went to a lower low. It spiked up to here. It went to a lower low. Spiked up to here. We've got a higher low. If this is the case, if we break out right here, then this is what's going to cause me to turn more bullish. And as much as I think there's a lot of bad coming, if the market breaks out, you got to kind of go with what the market does right there. Now, it could be, I'm not saying that it still can't drop down lower, okay? But if it does break out, then clearly it'd be the first time during this whole market decline that we would break out of that trend line. That's significant. You can't ignore that. It would also then establish this as a potential higher low, which would be more bullish. If we can break out above here, that would give you a higher high. Now you're starting to act like an uptrend, and you got to recognize that the market is starting to act like an uptrend. Now, if that does happen, okay, we already know that if it doesn't hold, it's probably coming down to this low, the lower part of that trend line, maybe even below it, and it's going to spike that VIX up above 30 and maybe even higher if it becomes a panic sell-off, okay? Let me go back into here. All right, so what else could be going on if we do break out and go higher. Well, part of the problem that I still wrestle with is that we've never had a major market bottom without a panic sell-off. You've heard me say this a number of times, and I'll continue to say it because it's been the case. Even beyond what my trading years, you can go back and look at history, and same thing. Every major market sell-off bottom has had a panic sell-off. We didn't get one during this whole decline. So what worries me is and this is why you might not want to be rooting for the market necessarily to take off from here, because it probably won't last very long. What I want is I want to get this thing over with. I want to get the bear market over with. Let's get our panic sell-off. Let's drop down the levels that we need to drop down to, and then let's get back to a bull market, that one that can break out and go to new all-time highs and back to the happy place. Okay. If we break out of this trend, what I'm worried about is that this whole move right here, and we might have to go back a little bit further to get the context of this. Sorry, I'm spending a lot of time on this, but it's because we're at this critical area. I mean, you got to pay attention to this. So here's the bull market from the COVID lows right here. And we could even go back further because it may be corrected. This could be correcting an even bigger, probably back to the financial collapse of 2008, 2009, when we bottomed out in 2009. What I worry about is if we break this trend line through here, that this is just wave A of the correction. And it could mean that we're going to rally up, but this is a smaller A, B, C. Maybe we rally up into this area right here of a wave B, and then we get the massive panic sell-off, probably bring it all the way down to here. And it's coming, which means that we really can't get going on our buying right here. We can jump into a few things and maybe we make a little bit of money, but we're still going to have to worry about this bigger decline that could happen. Now, obviously, if it just kept breaking out and it broke out to new high, then that was the correction right there. It didn't have a panic sell-off, and it did the lower probability move. Guess what? The market will do lower probability moves from time to time. It has to, because that's what makes it a market. Nobody can know exactly what it's going to do. And the way we don't know exactly what it's going to do is it throws us these low probability curves once in a while. And then it adds to the uncertainty, and that's what keeps the market at that point. But that's what you'd have to worry about, is that you get a bounce out of this, and it'd probably be about the same distance as this one right here. So you're talking about a 2 or 3 month bounce, and then you got another move down, and this move down is not going to look like this, choppy like this. It's going to be more like this. not exactly that steep. That was one of the most unique drops or sell-offs the market's ever had right there, but it's going to look more impulsive if that's the case. This is going to look more impulsive. And you usually do get more of an impulsive move in a wave C. Now, this is all choppy right through here, so we don't have a real clear A, B, and C, and that can happen sometimes. That's why I don't focus so much on the A, B, and C, but the choppiness of the move is more of a corrective type behavior, more choppy, more sideways. This isn't very sideways, but it's very choppy as we drop back down. What I'd like to see is to avoid having to prolong this. But again, market's not going to do what I want, but I'd want to see that sharp sell-off, hopefully right from here, that really drops sharply, that panics the market, and then we bottom out, and now we start to have a healthier rally at that point. We can trust the rally at that point, because you flushed out the people that need to be flushed out at the very end. We never got that flush out. And so again, we'll see. Like I said, it's a critical spot here. But what's nice about this is we now pointed out that what we're looking for. We know, if we blast up through here the next day or two, we will have broken that trend line, and we've got to start to turn more bullish. If it reverses sharply right here, we're glad we didn't chase this rally, and we remain patient so we didn't get wiped out on a decline. Because if it declines, it's going to drop a lot faster than it rose, and that's going to be a problem. Now, another thing you could be looking at too, although the trend line there is going to be a lot more important, but we've also retraced about 50% of this decline, a little bit more than 50%. We're right at the 618 retracement level, which is about as far as you'd want to see a retracement go. We get above that, now the probability starts shifting. It's no longer as probable that you're going to get a decline. It's more probable that you're in a trend reversal, which would mean back into an uptrend. So all these things are little stages along the way that when I talk about probability shifting, that's what I'm talking about. There's these little subtle things that can indicate where you're more likely to go. Just a week ago, like I said, with this correction, this impulsive down, this corrective move, the higher probability was that we're going to decline out of that. Now it's challenged that a little bit through here, but it's still valid. It goes up any further now, and it significantly changes that outlook. It becomes undeniably more bullish, and but for how much longer, that'd be the problem. It may only be, because it'd probably go up about the same distance as this move right here. So that was middle of October to December, basically started first part of December. So yeah, about 2 months. Now we've already started, so this would be looking at maybe March or something, maybe rally up until March, and then look out below, possibly again. All right, so now you'd also see that the Dow, if the market rallied up there, the Dow would break out to new highs. The Dow it's definitely held up a lot more, but again, the argument I've had against that is the Dow usually isn't leading; it's usually following, and so what I'd probably want to pay more attention to is, does the NASDAQ really start catching up? Because it's the one that's really lagged. It's also sitting at a 50. Well, you've got not only the 50% retracement of this move down, but you've got the underside of this support area right through here. You're bumping up against same kind of candle as you're seeing on the SPY. You've got the same declining trend line. Now this one's a little bit further away from that trend line, but if it starts to also break out, then they would all be bullish signals that you couldn't ignore. All right. Well, I guess this could be, and this is something that's been interesting, is that the Russell 2000, which is a leadership, you look at this as being leadership, is really outperforming the other indexes. It is gone well past that 50% 618 retracement level. Do you see it break out to a new high right here? If it does, that would also be a lot more bullish, and maybe it's playing catch up. I know that it's had the higher percentage moves in the rally days, so it's outperforming on this rally here. Again, it's all key to whether we break out. Now we should know by Tuesday. It's gonna go one way or the other by Tuesday. I can't see, because there's really not much room for it to pause. We come back here. Well, I shouldn't say that, because what could happen is you could do what it did back here. it hit it, started to sell off, and then retested it, and then came down. Could we drop a little bit tomorrow and then rally a little bit on Monday and be right back to the trend line again? Could it bounce around this a little bit before dropping? Absolutely. You have to allow for that possibility, and maybe it does that. Maybe because we're not the only ones that are seeing this trend line. In fact, you'll probably start to see everyone talk about it now that it's right there, and the 200-day moving average right there. So if you're not even looking at the trend line, but you're looking at the 200-day moving average, you're saying it's everything's bumped up against that. It could be that we just kind of move sideways along this area here until people kind of forget about it a little bit, or stop paying attention to that trend line, and then it drops. All those things are possibilities, but that we're waiting to see if we break out or we start significantly trading away from this area. We should see one of those two things happen here real soon. And hopefully it's by Tuesday, so we have something new to talk about. All right. Bond market has been rallying. Again, I come back to hard to read this because you got impulsive up, impulsive down. And this is looking more impulsive to the upside. Although you have a little bit of a back and forth through here, a little bit of a sluggish movement in here, right in this area, right. Oops, erase the lines here in this area right here. But the easy way on this one is if it breaks out above here, it's more bullish. If it breaks down below here, it's more bearish. We're still kind of in the middle there. But that's kind of what if I don't see a real clear impulsive corrective alternation going on, then I'll just draw these little trend lines here. Take the low from the previous low and the previous high. We break out above the previous high, that's bullish. Break down below the previous low, that's bearish. And we may not get a clarification on this one by Tuesday. There's only 2 more trading days until then. So, actually, market, I believe, is closed on Monday. I forgot to mention that. I'm pretty sure it's closed for Martin Luther King Day. I guess I should double check that. So with maybe that tomorrow is the only trading day before Tuesday. So, but still, I would assume that we're going to have some clarity there on that breakout or breakdown by Tuesday. We should know. I would think. Gold continues to go higher. It's in that extreme reversal risk, but it's kind of getting stretched a little bit here. The rubber band is stretched a little bit, so it doesn't mean it's going to come down. It could just move sideways to alleviate that overbought condition. But a lot of times it does come down, although this has a history of just more sideways movement. See, it kind of had this big upward move right through here. And then right into here, it moves sideways. So it kind of alleviated that overbought condition and took off again. Could do the same thing where it just kind of moves a little bit sideways. A lot of the movement in gold has been because all the commodities, almost all of them, I think, have rallied a little bit recently. It has a lot to do with the dollar dropping. So the dollar is could be getting to a little bit of a stretched area here. Oil is a bearish indecision candle today. Actually, a little bit of a bearish. It could end up being a bearish reversal. It gapped up. It is currently trading lower than where it opened, which is a very bearish price action. Does have intraday highs and intraday lows. A little bit of what we call a spinning top type candle formation, which is technically an indecision candle. You'd want confirmation on it. If it holds, if this is how it looks at the end of the day, we got an hour and a half before the market closes. But again, what I talked about on Tuesday, I'm not going to go into detail today to save some time, but I'd want to see if it can break above here. That'd be bullish. If it breaks down below here, that'd be bearish. This is, we've seen it. It's a lot of sideways movements in oil over the last little while. Look at a 1-year chart. You can see a little bit more detail. A lot of choppiness in there. And so the reality is oil's not trending strongly in either direction. It's moving sideways. So that's another thing to pay attention to. That and when that happens, what you focus on less on is trying to guess a trend on there, and more look at the range. You want to look at these ranges. You got a little bit of a kind of a declining trend line through there. Here, you got a little bit of horizontal support in this area here. So we're right in the middle. We could go either way, but if it gets up around here, you might expect it to pull back. If it gets down below here, you might expect it to rally. You can kind of see these spots on the chart to gauge that. Because of the whipsawing it's been in, although oil stocks have been the leadership sector, I haven't liked a lot of the individual oil stocks, and a lot of them haven't looked overly bullish to me. I've kind of just stayed away. But that could change if we start to see the oil break out of some of these levels here. If it starts breaking above some of those levels, then that could change. Now that could be more bearish for the market if oil takes off, though, because of obviously the inflationary. People got to spend more money on gas. You remember that back in the summer? Wasn't too fun. All right, the dollar continues to go lower. It's getting stretched, though. It's in this extreme reversal risk range. Now it could go a little bit further and get to the far left side of that, but you don't want to ignore that. It's getting stretched. It's a little oversold, and doesn't mean it has to rally, though. It could. What we've seen it do recently is just kind of move sideways to alleviate that oversold condition. Got very oversold right here, moved sideways through here, and then dropped. Could do the same thing. But the trend is clearly still down on the dollar. If it starts to trend up, that's when you could see oil pull back, gold pull back, commodities, any sort of commodities start to pull back if the dollar starts trending up. All right, we already looked at the VIX. I'm not going to go through all these other ones here. Let's get to some stock specific. Well, again, the purpose of doing the market update ahead of looking for trades is you want to know the conditions. And this is very similar to Tuesday, where we're approaching this area. You really wouldn't want to get into anything today, okay? Until you get that bullish confirmation of the market breaking out above that key trend line, key resistance area. The last thing you want to do is just is guess, okay? Oh, I know it's going to break through here. Jerry doesn't know what he's talking about. This market's charging higher. I'm going to get in right now. That's fine, but if you're right, you'll make a little bit more money. But if you're wrong, markets fall a lot faster than they rise. And if this is where we get the panic sell-off, you're going to get destroyed and destroyed quickly. So it's in your best interest to be a little bit patient, wait to get the confirmation of breaking out. And so today we're going to be just building a watch list. Then let's get some stocks that we can be ready to get into if we do end up breaking out. Aerospace, again, I've talked about these. Now, aerospace had a pretty sharp sell-off recently with some of the stocks that I liked. Now, I remember when I was pointing these out, the market was still in a condition where it could sell off, and so I said you might want to wait to see if the market sells off. And what happened was the market did sell off, but these stocks sold off. They were, and I still like these, but they'd have to start trending back up. I don't want to just guess if they're going to come back up. Oh wait, not energy. We want aerospace right here. Northrop Grumman, been a phenomenal stock, but that's a pretty deep sell-off. Now it rebounded quickly the last time it did it, down in here, but that worries me that it dropped that quickly there. And I think when I was going through these, I said the safer trade, because we were right up in here. I said the safer trade would be to wait for it to break out. And if you did that, and if you were waiting for it to break out, then you probably avoided the dip right there. I do like, but this one, I'd keep an eye on it, because it could, if it starts to show strength again, I think these companies are going to make money for a long time, next few years. There's definitely a fundamental reason to believe that they'll keep going higher. But I'd stay clear of it for now. Lockheed Martin held up a little bit better, but there again, you'd probably be safe to wait for the breakout. And that would probably give you the confirmation with the signals too. Let me switch this over to signals. Yeah, sell signal right now. You don't want to be jumping in on a sell signal. If it breaks out, it'd probably go back to a buy signal. But I'd look for both of those. Because it could go back to a buy signal like right into here. Why not wait for that little bit of extra confirmation of breaking out? Now, sometimes if you wait for the breakout, it has a big move when it breaks out, and you miss a good chunk of the move. So I'm not always saying I wait for the breakout, but I tend to not. If I'm not going to wait for the breakout, it tends to be more because we're in a bull market or more in a bullish condition where I have more confidence that it should continue to follow the market averages. We're in a bear market, so we got different conditions right now. You'd want to be a little bit more cautious, look for a little bit more confirmation than you might normally look for. All right. But there is another aerospace in the hold section right here that has held up pretty well, which is General Dynamics. A little bit lower strength rank at 86. I do recognize that, but it's been in this consolidation for a while. You can make the argument that, well, is it going to have its dip like the other ones did? Maybe, but it didn't really drop with the other ones right here. I'd still probably wait for a breakout. There's additional confirmation. It's gone back to a buy signal a few times before it's broken out of this area here, but wouldn't be too bad to get that extra confirmation. Now, if it does break out, there is a rule of thumb. I bring this up all the time, and hopefully if you've been following me for a while, you know it by heart now, but you can take the top of the range and the bottom of the range. So if you break out of a sideways consolidation like that, you can take the distance of the range and project that upward, and it gives you kind of a minimum target. Now, it doesn't mean it's going to go right up to this area and come down. But it very, very probable that it'll get at least to that distance. And so it helps you, well, knowing these things helps you stay in trades. It helps you give you something to visualize. Okay, it should get up into this area here. So if it goes down for a day or goes down 2 days in a row, you don't panic and say, I got to get out of this thing. It's going to come all the way back down. No, it should reach at least this area, and it helps you deal with those emotions of when things go back and forth. Stocks are always going to go back and forth. That's what shakes people out of trades. If you don't know why you're in the trade, you don't know you don't have a plan, it shakes all those people out of the market. And what prevents you from doing that is when you know exactly, and it could be that you're in it until you get the sell signal. Okay, so that's the purpose of the signals too. Is okay, you're going to wait. You can be disciplined. You're going to wait until the stock flashes that sell signal to get out, or it goes back to a hold signal or something like that, whatever your plan is for that particular trade. You got to have something to anchor yourself into when you're trading. And there's no perfect way to do it. And this is just one technique, but you can use this with a number of different things. You could say, okay, let's say you get up to that distance and the market, and you have a buy signal, and then suddenly it comes back down to a hold signal or something like that. You might say, okay, it reached that distance, it's going back to a hold signal. Maybe I decide to get out because of that, because it just so happened to go to a hold signal after it reached that target area. Or maybe you move up a stop loss. If it does that, maybe you move your stop loss down from down here to up just below the breakout area or something like that. These things can help you. Knowing these things can help you make decisions and have confidence in the decisions that you're making. All right. So I like general dynamics. If it can break out, let's go through some of the basic materials. By the way, if you're wondering why I go to the hold section, because if I like I'm looking for the top sectors, and then I'm looking at high strength ranked stocks within those top sectors. So I usually like to stick to about 90 to 100 or 99. My favorite is kind of that 98 range. Now that one on general dynamics dipped down a little bit to 84. You might have to do that coming out of a bear market or while you're in a bear market, just because there's not going to be a lot of stocks. You're going to have a lot of stocks that are beaten up, but are looking better, and gives you if you're just looking for 98 strength rank, you may miss some opportunities of some good stocks that are climbing back up. If you're in a bull market condition, there's really no reason to go below a 90 strength rank, or at least not to do it very often. But I liked this AMR at the top up here. 98 strength rank. Oh, and then the reason why I'm looking under the holds is that if I see a good pattern that has a nice strength rank, then the final confirmation could be to wait for it to go from hold to buy. And so it's already at a hold, waiting for it to go to a buy, and it's confirmation. Now, what I like about this one is, again, what I'm looking for here are chart patterns, or some of these are in clear uptrends, but this looks like a trend reversal pattern. It looks like an inverse head and shoulders pattern. Now, what I like to see on an inverse head and shoulders pattern is usually the right and left shoulders are going to end about the same spot. That's pretty close. And I'm not looking for exactness, but it's, I'd like to see the head. I'd like to see more of an impulsive move down, impulsive move up. Now, this had a little bit of a correction right in through here, but that's a pretty sharp move down, very sharp move back up. And then here's your neckline right here. This lines up with some previous support. Now it's acting as resistance. Back here it was support. If you break that neckline, that's very bullish. Now, this is also, you can use this rule of thumb as well. If it breaks out above that neckline right there, you can take the distance of in this case, the bottom of the head to the neckline. You can project that distance upward. That gives you a minimum target. Now, this target is very valid because it also lines up with this area up here. You got additional reasons to believe it could get up to this area right here. And so if this breaks out, it'd probably go to a buy signal, probably pretty close to going to a buy signal, and has a pretty high probability of at least getting up to that area right there, barring a market panic sell-off. So I like that pattern. Now you can see how close it is to, actually it's still a little ways away from going to a buy signal. Usually when it's really close, it'll be on the right side of this whole range, and any sort of an upward move would push it right into the buy range. This would probably take a couple days. So it would probably clearly be breaking out of this resistance area right here, probably up in this area right here to go to a buy signal. I like that one. It's a mining company too, which they've done pretty well lately. I've been in some gold mining stocks. Under construction, the one at the top here, 94 Strike Bank, FLR. Had this nice little run up right through here. This looks like the ABC correction. Now, what do you like to see in the C leg? You like to see like it should look impulsive. It should look very sharp to the downside, which it does look like right here. This is what I'm saying. This kind of wave A was a little bit more kind of choppy right through here. This goes back to what I was just showing you with the market. Remember, I showed that big long-term going back to the COVID low. If this is where the market is right now and we're in that wave B, then we got an ugly wave C coming, and it's probably coming near the middle to later part of this year, and it means that we have to wait a lot longer for a new bull market if that happens. So you almost kind of rooting for it to just flush out right now. Not that it'll do what we want it to do. What's also bullish about this too is if this is the end of a correction, this first movement out of it should look more impulsive, and that movement looks pretty impulsive to me so far. That could change, but it's looking pretty good. Again, could you wait for it to break out? Probably a smart idea. Get that additional confirmation. You got a little bit of a sideways range into here that you could project up. Well, just to show you, okay, so here's a sideways range. Take the distance of that sideways range, project it upward. Look what happened. Bumped right into it. Now, again, it could just break out and keep going. I'm not saying it can't do that. By the way, you can do it on these types of where you don't have a real sideways correction as well, though. You could take, like I could take the distance of this correction right here and project that upward. Now that it broke, it didn't stop right into here, it broke right through that. But it's kind of interesting that suddenly that distance right there suddenly became the support right into here. So in other words, I could look at this sideways range and, like I said, project that. Or if this is an ABC pattern right here, like I said, you could take the top of the ABC, beginning of the ABC pattern, end of the ABC pattern, and project that distance upward. Like I said, you're not going to base. I mean, this is not absolute. Okay, so I don't want you to think, well, it's got to get there. They call these rule of thumb, right? And something doesn't become a rule of thumb because it rarely happens. It happens a lot to where it's not perfect. It's not a law, but it happens enough to where you can have some confidence that there's a strong probability that it should happen or take place. So I use this all the time in making decisions on exits or moving stops or, all that kind of stuff. And it doesn't work perfect, but it gives me some, like I said, it's an anchor. It gives me something that I can have a little bit of confidence in when I'm making my decision. Let's do a couple more real quick here, and then we'll wrap things up. Industrial products. I like this BDC 92 strength rank. And again, it looks like this is the correction right there. Well, you can go back. You can see it. Probably can go back to a longer term chart. And you can see the trend on this one. That's a nice trend. I mean, you got a nice little trend channel right through here. It didn't come all the way back down to that lower trend line, but it's starting to move back up, went back to a buy signal. I would expect that if the rally continues, it should move to the upper trend line right there, break out to a new high. That looks pretty good. Question: what market conditions are best to switch to the reversal pattern app? Usually more in bull markets, because what you're looking for in that app is you're looking for deeper pullbacks within a bull market, and those stocks could be starting to make bigger moves. But you need to have stronger buying. What happens in bear markets is stocks that are beaten up a lot tend to move more sideways. They may not go down necessarily a lot. Like you look at a lot of the COVID stocks, they've been way beaten down. In fact, some of them they're down below $5 now. Whatever. They're on verge of going out of business. There's not much further they can drop. And so a lot of times what will happen is they'll start to move sideways or form a nice long base, and so you'll probably see a lot of those stocks that are just they dropped and they're just moving sideways, and you'd almost be waiting forever for them to take off again. That app tends to work a little bit better in bull market conditions. I'm not saying you can't find anything in using it. You can find anything if you want to take the time and go out there and look. But I get back to the main problem of the bear market is markets sell off a lot faster than they rise. And that's the thing. Some of these trends look pretty good. And they've done pretty well. But when you get those panic sell-offs, everything drops. And so this stock that's looking really good, if things got ugly, I guess it could be all the way down here within a few days. And so that's why you don't want to have that much exposure in bear market conditions. You can still trade, and we're still trading, but you want to have most of your money in cash to help avoid wiping it out. Because the worst thing is to wipe out your money and then you bottom out, and that's the best time to be jumping in. And you spend the first half of the new bull market just trying to make back the money you lost at the last part of the bear market. All right, one more. Business services. This IBEX right here, 97 strength rank. Again, you can see it's just consolidation right through here. It's held up pretty well lately. Big run up right through here. Might want to wait for a breakout. A little bit of additional confirmation wouldn't be a bad idea. But again, build a watch list. Put some of these stocks in a watch list, and like I said, hopefully by next week we have some clarity on which way this market's going, and we can start making some decisions there. Not doing anything in the portfolio. I'm still holding the SPXS as a little bit of a hedge. It's my stop, I believe. We'll have to double check. I thought maybe I had a tighter stop and I need to stop out. I have to look at that. What was my stop? Stops at 20. Oh yeah, I'm below the stop. So I'll go ahead and stop out of this one. I may jump back in it again though if the market starts selling off. It's at 1981 right now. So 1981, not too far away from where my stop was. All right, so I'm still holding the gold stocks. They're a little bit stretched. They could consolidate a little bit here pretty soon, but I'm looking for trying to stay in these things for the longer term at least right now. So, all right, that's all I have. Well, real quick check. Let's take a look at the SPY. If anything dramatic's happened. Well, off the highs of the day, I don't really think that's going to change much going into the close. It could, but like I said, tomorrow's I think is going to be a really key day. And I'm pretty sure the market's closed on Monday, but I'll double check. You might want to double check that. And then we'll be back here Tuesday for the market update. All right. Thanks, everyone. Have a good weekend. Bye now.